So go ahead and follow along in your workbook as we work through an example of a long risk reversal. So in this example, we're going to use a stock, Aristanet. This is actually a company that I've been very bullish on over the past year. My research firm has really put out a lot of good bullish content on it. And so this setup actually makes a lot of sense. So this is Arista, and the ticker is ANET. The date of this trade is going to be August 15th of 2017. Again, I think the stock is going to trend higher, so I want to put a long risk reversal out till December. So how am I going to structure this trade? Well, I'm going to sell one of the December 165 puts, and I'm going to collect $11.35 in premium. And then at the same time, I'm going to buy one of the December 175 calls, and I'm going to pay $12.75. This is going to be a net debit because I'm overall paying for this structure. But let's look at how the stock actually plays out. So the stock is in an uptrend. You see right here, this is where our P&L starts as we put on this trade. And what do you notice? You notice that the P&L is tracking, it's simulating being long stock. So as the stock is going down, your structure is worth less. As the stock is going up, the structure is worth more. So that's what I mean when I say it simulates being long stock. Overall, what can we see? Arista.net really had a huge bullish move to the upside. So this is going to be a very profitable strategy. So again, ANET is the stock. It's trading roughly $170. This is August 15th, 2017. Let's go ahead and calculate our max loss. Now, since this is a net debit, right, I'm paying for the structure, the way you're going to calculate your max loss is you're going to take the put strike, 165, you're going to add the debit amount of the structure, 140. That equals 166.40. So 166.40, then you have to multiply the number of contracts that we're talking about. It's 1 by 1. Then you have to multiply times 100. Your max loss, $16,640. So that might seem like a large max loss, but remember, we sold a put. That's synthetically buying stock. Stock could theoretically go to zero. So your max loss could be that the stock goes to zero. Not likely, but it is your maximum downside. Now, to calculate your max gain, it's very simple. Since you're long a naked call, your max gain, therefore, is unlimited because the stock could go to infinity. So now let's go through break-evens and then the net result. So your break-even, if this is a net debit, is going to be the call strike, 175, plus the debit that you spent on the package, which is 140. That equals 176.40. Stock needs to be above 176.40 for this to be a profitable trade. What is Arista Networks' price at expiration? $231.03. So let's go ahead and calculate the net result. Remember, ANET was 231.03 at expiration, so that's well above the put that you sold. So for the put, remember, we collect all that premium that we received. So that's $11.35. Now for the call, at expiration, the 175 call is worth $56.03. But remember, we paid $12.75 for that call. Add all of this together, and you made $54.63 on the package. But don't forget, you got to multiply times the number of contracts. In this case is 1. and also the 100 multiplier. The net gain is a whopping $5,463. So to conclude, the long risk reversal really works out when the stock pops and gains nicely. So remember, adapt the risk reversal to your hypothesis. You need to have a reason to expect upside in the stock. Also, assess the outcome of applying this combination to your strategy. Know your break-evens, know your max loss, know your max gain. Now go ahead, try another example in the workbook provided.